A very good evening, everybody. Welcome to part one of the three-part webinar series on the VIX Index. Tonight's webinar is called Introduction to the VIX Index and How Investors Can Use It. I'm Ming Hui from Phillip Futures, and speaking to us today will be Mr. Tim Edwards, Managing Director of Index Investment Strategy for S&P Dow Jones Indices. Tim will be sharing with us what the VIX Index is and how you can use it for portfolio hedging and more. Also speaking today will be Mr. Ethan Lee, Business Development Executive at Phillip Futures. He'll be sharing on how you can start trading the VIX Index with us, so stay tuned. And before I pass this on to the speakers, I'd just like to inform you that if you have any questions throughout the course of the webinar, please feel free to drop them into the questions box as we will have a live Q&A session towards the end. And now, without further ado, let's have Tim speak to us.
Hello, everyone. A very warm welcome to this webinar. Thank you for taking the time to join us. As mentioned there in that short introduction, this is the first of a three-part series. I've been asked, and it's my great pleasure to come and talk a little bit about what the VIX is, what it means, pretty top-level introduction to how it ticks, and to talk a little bit about VIX Futures, how they're used, and who uses them, and why. Following up in just over 2 weeks, there will be another session likely to be presented by the Cboe Exchange on how to trade VIX and mini VIX Futures. And a month from today, we will have Richard Sheen from Smartwise coming to speak about real-world applications of VIX and mini VIX Futures. But today it is the introduction, and this is what we're going to talk about. So we'll start off by saying, what is the VIX? What does it do? And what does it mean? So what is it telling you when the VIX level is 30 or 20 or going up or going down? We'll look at the behavior of VIX over time and its reactions to broader market trends, what happens in the sell-off, and so on. Then we'll talk a little bit about the investable aspects of VIX, which, for the context of this webinar, will really be VIX Futures. We'll talk a little bit about the participants and the applications, and we'll finish with a few words about the global volatility perspective, or as I will, and then I'll hand over to Ethan to talk a little bit about brokerage aspects. My piece should take roughly around 35 minutes or so. Then Ethan will speak for 10 minutes or so. Questions will be at the end, and we've tried to make sure there's plenty of time at the end for questions. So please, as you're watching along, if questions do come to you, please do save them, and we will try to get to as many of the questions as we can at the end as we can. But with that, let us begin. And I actually thought it might be useful to do a bit of a prelude to this. I thought I'd start with this quote from the philosopher Camus, who wrote The Plague in 1947 about the conditions of lockdown during a pandemic. And he said there's been as many plagues as wars in history, and yet plagues and wars take people equally by surprise. And that certainly was the case last year. Now that 2020 is in the hindsight and it's in the history books, there's lots of fascinating aspects of the market which we can now tease out and examine. But the top level story was the supreme levels of volatility that we saw. So this is 2020 from a volatility perspective, actually running up to a couple of days ago, last Friday. First thing I'm showing you on the left is the size of the daily swings in the S&P 500. Now, over the super long term, you might expect to see somewhere between 0.5%, 1% daily move in the S&P 500. Sometimes you see much bigger swings. That is the very essence of the notion of volatility. And in March 2020, we saw the highest level of volatility, the biggest, largest daily swings, in fact, on record. There were a few days when one day the market was up 10%, the next day it was down 12%, and over the month of April 2020, we actually saw the highest volatility ever on for any month for the S&P 500 in a history that stretches back to 1957. The sound, sorry, do forgive me, I'm just getting a message that the sound is a little choppy. I don't know what I can do about that. Is that better? Can you hear me better now?
It's actually still a little bit choppy. Would you like to try removing the earphones?
I'll try. Is that a little better?
I feel the connection is better, but it's a bit softer.
Okay, well, I'll try and speak loudly, and my apologies if people were struggling to hear. I will try and talk a little slower, and again, my apologies. That is the challenges of operating virtually, as we're all doing nowadays. Anyway, so March was the most volatile month ever for the S&P 500 in a history that stretches back to 1957. Realized volatility running at 93%. It was also a record high for the Volatility Index, the VIX reaching the level of around closest to 83 on the 16th of March 2020. And one thing that was interesting, or I found interesting, was that the US equity market actually recovered very quickly. In fact, by the early summer, the S&P 500 was making not just a full recovery, but making new all-time record highs. And the S&P 500 has kind of continued in a straight line since then. However, the VIX stayed elevated all through last year. It has only started to come back to ground in the last month or so. And you're seeing there something that's fundamentally characteristic of the VIX. Because although the equity markets had recovered and were making new highs, that high level of uncertainty and those large, more than 2% daily swings in the S&P 500 continue. That really emphasizes that it's not just the inverse of the equity market. It's, sorry, another message. Could I please put, all right, hopefully this will be the last time we're interrupted with a You can still hear me, I hope. I'm going to continue and look out for more messages. So as I was saying, that higher level of uncertainty meant the VIX remained elevated even while the equity markets recovered. And this volatility as something that is actually tradable was incredibly useful to investors last year. And you can see this in particular in volumes in VIX futures. So this is over a decade of trading statistics for VIX futures, running back to September 2009. And you can see there that early last year, we saw an average daily traded notional value of over $16 billion per day on average during March 2020. So people really using volatility as a way, or using the tradability of volatility as a way to navigate the extraordinary market circumstances that we saw last year. And it's worth, before we go into the full detail, it's worth highlighting that the tradable VIX complex is essentially the tip of an iceberg. So you have, and we'll talk a little bit more about this, but you have VIX futures, which are based on VIX. The VIX itself is based on S&P 500 index options. These are one of the most liquid instruments in the world. They themselves are based on the S&P 500, and the S&P 500 has the most liquid future in the world and actually supports a wide range of tradable products. And so unfortunately, we haven't updated this research. We're planning to do that soon. The latest time we did this was in the summer of 2019. We took all the various different ways that you can trade S&P 500, the index itself, looking at futures, options, ETFs, leveraged ETFs on the left-hand side. And on the right-hand side, those products that are derived from the S&P 500. So the sectors, factors, things like growth and value, the dividends themselves are tradable, and of course you can trade the S&P 500 in various different currencies. These figures are annualized volumes of economic value traded in billions. So futures, for example, the total figure there over a year is $61 trillion of value traded. In options, about $50 trillion of value traded, and in VIX around $2 trillion. What I wanted to illustrate with this is the fact that the VIX relies on a deep ecosystem of S&P 500 based exposures. So liquidity in the VIX is kind of built from and relies on this broader liquidity and tradability complex in the S&P 500. So that's the prelude, just to sort of whet your appetite for what's to come. But now we'll take a step back and ask, what is the essence of VIX? And the quote I chose for this one is because we'll talk a bit here about whether or not VIX is predictive. I'll make the case that it does give you information about the future, but it is not a perfect predictor. In fact, it's a very flawed predictor, but that doesn't mean it doesn't contain information. Having said that, it is generally good advice never to make predictions, especially about the future. So what is the VIX? Well, you may know this already. So VIX is known as the SIBO Volatility Index, or the VIX, same thing, it's just a shortening, and it tells you the 30-day implied volatility of the S&P 500. By implied, that means implied from options prices. The VIX itself is based on a calculation, the inputs of which are the prices of listed S&P 500 options. So it's a broad strip of call and put options based on the S&P 500, traded on the SIBO, and you take those market prices and you combine them together in a certain proportion, and that proportion is really designed to represent what you would need to buy if you were hedging something called a variance swap. Now, the important thing about that is that it doesn't rely on any particular model. It's not based on Black-Scholes or any other complicated way of modeling what should be the price of an option. Instead, it's based on a basket of options, which if you held them and continued to hedge them properly, your payout over the next 30 days is linked to the realized variance of the S&P 500. Again, over the next 30 days. Now, it is very much related to the S&P 500, but just to emphasize, the actual level of the S&P 500 index itself is not an input to its calculation. But what we'll see is that the two are very related to each other, and to such an extent that VIX's primary use has become as a kind of sentiment indicator of US equities, and is very often referred to in the media as a Wall Street fear gauge. When VIX is high, that means the market is very worried, it's very afraid. When VIX is low, potentially means that the market has become complacent. Now, the VIX was based on a methodology that was developed together with a few traders, as well as a professor at Duke University, or then of Duke University, called Robert Bailey. They brought in the new methodology and launched it in 1993, and provided a couple of years of history. So you have a daily history for the VIX index that runs back all the way to 1990. So you've got over 3 decades there of daily history that you can study. Intraday history, depending on your data source, also available for much of that. And there are a few things that you might notice already just from looking at this historical chart. The first is that volatility itself, or the VIX itself, is volatile. Right? You see big swings in the overall level. So it's something that does move around quite a bit. But that's not all. There are a few more things that you can observe here. The first, and this is most visible on those 2 big spikes that happened around the financial crisis and around the COVID-19 sell-off, is that VIX tends to spike up very fast, but come back down more slowly. So it's not symmetric like that. It spikes up and grinds down. I've heard it said that the VIX takes the elevator up and the stairs down. The second thing that you might notice is that it's essentially range bounded, or it's been range bounded historically. The lowest level ever observed in the VIX was 9 and a bit. We mentioned earlier the March record of around 83 as the highest ever. It doesn't tend to spend much time at the extremes. It tends to spend most of its time between about 15 and 25. And when it is high, it is quite likely to come back down. When it is very low, it is quite likely to come up. So that's a characteristic known as mean reversion. Over the long term, you expect VIX to come back to its more normal level. And the third characteristic that is not quite so visible on this chart, but is more visible if you narrow down, is persistence. I don't know what the VIX will be tomorrow, but if you ask me to make an estimate, a very decent estimate would be, I'd say it's probably going to be roughly where it was today. There is a degree to which the volatility goes through regimes, higher volatility, lower volatility. And if you're in a high volatility regime, although in the long term you expect that to come back to normal, in the short term you expect to stay in a high volatility regime when you're in one. So those are a few characteristics of the VIX that are almost immediate just from looking at its historical chart. One that's not quite so obvious, but I will point out and go into a little bit more detail, is its negative relationship with the equity markets. So I've overlaid here on that chart the price level of the S&P 500, which goes from the bottom left to the upper right. And what you can see is during those periods of sell-offs, the bursting of the tech bubble in the early 2000s, in the great financial crisis, especially as the market sold off dramatically in late 2008, and again when the equity market went through its fastest ever phase of going from an all-time high in mid-February to a formal bear market only 4 weeks later. Those are the points when you see VIX rising. So that negative correlation between VIX and equities is obviously an important characteristic that makes it intriguing from a hedging perspective and intriguing from a macro perspective. But it's not just a negative correlation. In fact, it's even more powerful than that. So what I've done here is shown you over that full history, what was the daily change in the VIX, that's on the x-axis, and what was the daily change in the S&P 500, that's on the y-axis. And somewhat suggestively, I've drawn a red dotted line over it because I want to make the following point. If you look at that pattern, what you see is something called convexity. When the equity market gains, typically VIX will decline. When the market falls, typically VIX will rise. Opposite, negative correlation, but it's not symmetric. You tend to see a bigger VIX spike when market declines than a VIX decline on market gains. Now that makes it particularly interesting as a hedging vehicle, particularly a short-term hedging vehicle, because that's exactly the characteristic that you want to see from something that is a hedging vehicle or portfolio insurance. You hope it doesn't hurt you too much if you don't need it, but you really need it to come through for you if your hedge turns out to be needed. So those were a few characteristics. The next piece, moving on to that aspect that I mentioned of predictability. So again, it is not a perfect predictor, but it is predictive. So what I've done here is run through and looking 1 month forward, rolling 1 month, all through that full history. And so what was the level of VIX today? And then 1 month later, what did the S&P 500 do? And in dark blue, you can see the distribution of future returns of the S&P 500 for a VIX below 12. In lighter blue, for a VIX between 12 and 20. And in the lightest blue, what happened when at the start, the VIX was above 20. And very clearly there, hopefully that answers resolutely the question as to whether or not there's predictive power here. It's very, very clear that a higher VIX has historically predicted a wider potential spread of S&P 500 returns. Now, that's for a VIX going up to above 20. You may well ask, well, VIX has gone all the way up to 80 on occasion. What about when the VIX is genuinely high? Well, the VIX doesn't spend much time above 40, but when it does go above 40, that's the distribution historically that we've seen. So essentially, what you can take away from that is when the VIX is above 40, it's anyone's guess as to what the market might do over the next month. Now, speaking of how often the VIX is above 40 raises the question as to what is a typical VIX level. You saw an indication with that historical chart. Here is the full frequency distribution. So this is based on, excuse me, based on daily VIX levels and their frequency over that history back to 1990. And you can see it's kind of a funny distribution. It's not something you are perhaps that familiar with. It's a very strong positive skew. It's not a normal distribution. So what is a typical VIX level? Well, the mode to the nearest whole number is 13. That's the most common VIX level. However, the median is higher at 17. So 50% of VIX daily closes were below 17, 50% were above. And of course, that wide tail of higher values means that the average is much higher. In fact, the average is about 19.4. And of course, you've then got that long tail of VIX spikes with a very few occasions when VIX was above 75 listed there. So 3 last year, 3 in 2008, at those rare times when it was above 75. And you can also think about, short term, what is a VIX of 30 telling me? I promised I'd give you an indication. So narrowing those bars up to say, how often was to the nearest 5 points was VIX nearer 10, 15, 20, 25, 30, and so on, or about 40. And on the right-hand side, just looking on a much shorter frequency, what was the average next day change in the S&P 500? And this is a kind of handy, tangible sense. What does a VIX of 30 mean? What does a VIX of 20 mean? On average, a VIX between 20, 25 is telling you we're expecting a 1% daily move in the S&P 500. With a VIX above 40, it's more than 2%. With a VIX down 10, those are the good times when the market's just popping up by 40 basis points or down 40 basis points on average. Now, of course, all of this analysis is based on the history of the VIX, which does only go back to 1990. And I want to give you an indication that you can somehow backtest this or stretch it back. It's very connected to just realized volatility. So here is a longer term perspective using the Dow Index, which has is just coming up for its 125th birthday. So you've got a century and a quarter of US equity history to look at. And in black, you have the 1 month realized volatility of the Dow Jones Industrial Average. And overlaid on it, you've got the VIX since that began. And a few things should be immediately obvious. The first is that the two tend to track together very closely. And the second, actually, it's, there was different ways I could have shown this or gone into more detail, but it's actually really clear here, is that VIX tends to be higher than realized volatility. This is structural, this is deep. You can get into a lot of theory around this, which I personally find fascinating, but the reality is, over time, historically, VIX has proved to be a systematic overestimator of realized volatility. So it tends to be a prediction, and one of the key facts of that prediction is that it tends to be an overestimate of volatility. And in part, one of the reasons is because most of the times interesting things don't happen, and sometimes they do. So based on that 125 odd years of history in the Dow, here's the distribution of monthly returns in the Dow. It's obviously 125 times 12, roughly 1 month calendar returns. And what I've done here is overlaid on that actual distribution, which is the light blue line, a best fit of a normal distribution, right, which is what's supposed to happen. And you can see that the normal distribution is a pretty decent fit for what goes on in the equity markets, but there are these so-called fat tails, particularly on the left-hand side. You can see at the minus 10%, minus 12%, they have happened with a higher frequency than you might expect. And in fact, when it comes to US equities, impossible things happen all the time, and I just want to illustrate that with a few statistics, again based on the Dow's history. So if you take that fitted normal distribution and say, under the bell curve, how often would I expect a loss of 5%, 10%, 15%, 20%, and so on? And a loss of -5%, a loss of 5%, you'd expect it roughly every 9 months under a normal distribution. It's happened historically roughly every 9 months, but when you go further down the tail, so for example, a loss of 30%, which did happen in 1931 in a single month, that would be expected under a normal distribution roughly once every 650 billion years. So for context, according to scientists, the universe itself is about 13 billion years old. So really, it is the case that you sort of get these things that are technically impossible from a probability standpoint happening all the time, and it's that potential for a big spike that often is one reason why the cost of insurance is typically higher than one would expect, because exciting things can happen. All right, so we'll wrap that up and then we'll move on to trading of volatility. But just to kind of summarize that segment, here are sort of stylized facts about VIX. First of all, VIX has a negative and convex relationship with the equity markets. So when equities go up, equities go down, vice versa, but not in a symmetric way. That's the convexity that makes it powerful for hedging. VIX itself displays a degree of persistence. There are regimes of higher and lower volatility, but even though you may be in a high volatility regime, eventually you expect back to go to normal, so mean reversion in the medium term. It is not a crystal ball, but it has offered a degree of predictive power, and it is typically an overestimate. There's a premium index to realized volatility. And one thing that I think is really important, I want to overemphasize this: the behavior on average with the VIX is very different to the behavior that's typical. It is not, we're not talking normal distributions here. It goes up much faster than it goes down. There's a big skew in the distribution of returns, and thus, when treating or when analyzing volatility in VIX, it's not always a great idea to just sort of take averages and assume they're representative. The behavior that is typical is very different to behavior on average. Now we'll turn to trading volatility, and the quote I picked from this is one of my favorites. It's from a French 16th century essayist called Michael de Montaigne, and he said, "My life has been full of terrible misfortunes, most of which never happened." Now that really could be a motto for VIX, because VIX is very concerned with the things that might happen, that could happen, very often don't. And just to whet your appetite, something that I think is deeply important about VIX is its connection overall to the very concept of equity trading. So what I've shown here is this is a comparison between the level of the VIX and the bid-offer spread, the average during the day, the bid-offer spread on the largest, most liquid or most highly traded ETF in the world, which is a US ETF tracking the S&P 500. And what you can see is that bid-offer spreads on that ETF, on equities generally, tend to be very closely associated to the level of the VIX. And in fact, one really can think of VIX as a proxy for liquidity. That embeds the concept of VIX very, very deeply in the notion of trading overall and trading equities in particular. But it's not just about managing liquidity risk that people are interested in trading VIX. In fact, there are a lot of different ways, uses. So I should go through this sort of reasonably quickly, but I can't go too deep because we don't have time. But just to do a whistle-stop tour. So who is trading volatility and what are they trading? So the primary and the most liquid components of VIX trading are VIX futures options. They're available on both weekly and monthly bases. There's the big VIX future and the mini VIX future, and I expect we'll hear a little bit more about that, not just from Ethan, but also from the other participants in this series. On the index side, what we've done is build indices of these futures, because obviously a future itself, it has a maturity, you hold it, you sell it, or at some point it'll mature. And so what we've done is we've built indices that represent holding the future and then continuously moving into the next future, so that you've got a constant maturity of either a short term, in the case of the short-term index, a 1 month rolling, or in the mid-term, it's on average it's about 5 months rolling from 4 into 7. And there are also more tactical strategies using VIX futures indices. I'll mention one of them, and they're also incorporated quite often into multi-asset strategies. And these indices have been used as the basis for providers to build exchange-traded products like notes and funds. Okay, so that's what they're trading, who's doing it, and why. So it really is a wide range. That there is a case to be made that volatility itself is now an asset class for the breadth and depth of uses. But included among those, it could be portfolio based. It could be used as a strategic hedging application within a broad equity portfolio, or it could be very specialized. Someone who's just trading volatility, perhaps looking at options positions versus VIX futures. It is very commonly used as an equity hedging device because of that convexity I mentioned. Because, and as we'll shortly whiz through, VIX futures have insurance-like properties. They're things that, if you like, to put it very crudely, pay out if the worst happens. And insurance tends to carry an insurance premium, and so selling VIX futures has historically shown long periods of strong performance. And essentially what you're doing is you're collecting an insurance premium, which is often called risk premium harvesting. Very commonly, of course, with VIX, you just have pure directional trades. I think volatility is too low, or I think volatility is too high. I think it will be changing direction. And that very links into a macro viewpoint. Over the past couple of years, not so much very recently, but over the past couple of years, a lot of trading around politics, political events. Very, very popular with arbitrageurs. If you know what you're doing, you can look at VIX futures and look at options and essentially think about recycling volatility risk from options to futures and back again if there's a mispricing in either of those. There's a deep and liquid market that we've already mentioned for arbitrageurs. Tail risk funds are big users of the volatility in general and VIX futures in particular, and they're part of a community of, if you like, volatility specialists that are using VIX futures in fairly sophisticated ways. And then lastly, you have what any liquid market tends to attract, which is market makers, dealers, options market participants who may well be hedging their volatility exposure with VIX futures, and of course liquidity hedge strategies. Just mentioned that at the beginning, using VIX as either an indicator or a hedge against a decay in liquidity conditions. So very much a whistle-stop tour. That's who and what. I will say that there is time at the end for questions, and I apologise only for just scratching the surface on that. But I also did promise to talk a little bit about what drives performance of VIX futures. So here is our long VIX futures hold and roll index. So there's always 1 month maturity on average, moving from the front into the front next future, maintaining a 100% long position. And I highlight, or I emphasize, note the scale of this chart on the left-hand side. So it's a logarithmic chart. So each bar is representing essentially a decline of 90% in the index. And to some extent, you should expect this. This is an insurance vehicle. Over time, you pay a premium. You see some spikes up, but overall, you pay for that cost of insurance. And roughly, you're seeing every 3-4 years, a 90% decline. I should stress, I don't think there's any investor who uses this on a buy and hold basis, and one really should view this in a portfolio context. Nonetheless, makes the point very clearly that holding and rolling over the long term is a cost of insurance that, of course, explains and drives that risk premium harvesting The challenge, of course, with, if you see a chart like that, you think, well, great, I short it. The challenge with shorting is that although there are rich premiums to be gathered from selling VIX futures, there's also the possibility that something exciting happens which could wipe out a high proportion of your capital. So this is the inverse version of that, if you like, an inverse held roll position, a very short position in VIX futures. What you see is that dramatic rise up. That's the premium harvesting. But in February 2018, you see nearly all of that wiped out by a spike in VIX. Now, you can't really see what's going on the right-hand side of that chart. So just because I know people will be curious, if you look since then, you almost get a microcosm of the same thing. You see that strong growth, some premium harvesting from selling VIX futures, which in March of 2020 this year, you again saw strong wipeout. So that's the sort of the two sides of the coin. One spikes up, the other grinds up. One spikes down, the other similarly and oppositely. Now, thinking about what really drives the return of the futures, I cannot emphasize enough that time is a fundamental component of volatility expectations. So here is taken from mid-September last year. You have a kind of funny-looking VIX futures curve on the left-hand side. You have the spot VIX was around 26. You had the first future, the October future, was up in the sort of low 30s, November high 30s, and then gradually heading back down. And this is so illustrative of the sort of things that happen to volatility markets. Why were VIX futures higher in November 2020? Because in particular, that was the date of the US election. That is a known event which was likely to cause volatility. That's the predictive aspect of VIX futures coming through. Now, why do they tail back down further into? That's driven by the assumption of mean reversion. And in the long term, you'll find that very long-dated VIX futures tend to not move that far away from a level of 2025. On the right-hand side, just to show that full history of the October futures and how they are, the longer-dated ones are less sensitive. So in light blue, you have the VIX itself. We saw it earlier, spikes up in the COVID sell-off, grinds back down afterwards. And you'll see that during that spike, the October future didn't rise by as much. The assumption was, by October, perhaps this crisis would be over and things would be back to normal. And that natural convergence you then see with, as that future got closer to expiry, it was picking up more and more of the sensitivity, more and more of the volatility of the VIX itself, and converging through to spot price. And the VIX futures curve is I always find it really useful, even if you're not thinking about trading volatility, to look at what are the market's expectations and where is the pressure, supply and demand for volatility out on the curve. I've put together a few examples from last year that kind of indicate the range of potential and typical VIX futures. So in light blue, where we were before the sort of COVID thing had really kicked off in January, you see a nice low VIX, you see a slightly higher front VIX future, which is very, very typical. And then only a month and a bit later in March, you saw the spot VIX right up to its highest level, 83. The futures were already pricing in some kind of return back to normality. And then the futures curve we saw before on October 9th there, showing that actually we're expecting the election, and after that we're expecting a sort of return to normal. Now, because of the dynamics of the curve, and because the contango or backwardation in the futures curve is so dramatic, typically 5–10%. I think currently right now, I should say back on Friday, 15% difference between the front and front next. What you see is that investments in futures have two real pieces that have different levels of importance depending on time. Recall it, time being such an important component. In the short term, what this shows you is the correlation of returns over different time periods. So in yellow, you see the correlation of the VIX Futures Index to the VIX Index. Over the short term, primary driver is the level of the VIX. And that increasing blue line showing you that as you go further and further out in time, that degree of contango, the spread in the front month futures, is actually becomes a more important determinant of what's your overall return. Now, what we haven't really touched on here, and I just would like to come back to, is that hedging component. I mean, it almost looks like I'm making a case to say you should sell VIX futures. I'm not, and this essentially is why. So the one thing that VIX futures really do that almost no other sort of options themselves can do this, but no other asset class really does, is give you that intense reactivity to crisis. So what you see here is I've picked out, and I've very carefully selected these dates. This is sort of from a low to a high. But what you can see is that, roughly once a year for the past 14 years, you've at least at some point in that year seen some kind of a concern or crisis come to shape the markets. And on the right-hand side, you can see that index change in the futures index really reacting to that in that way that we talked about, almost half an hour ago now, that convex relationship, the real pop in VIX and VIX futures that occurs when you do get a major shattering event for the equity markets. Now, I also mentioned people don't tend to buy and hold. The typical users of VIX futures do tend to be fairly tactical, fairly short term, often rebalancing their positions once a day or even more often than that. Certainly not buy-in. It's not a buy and forget kind of strategy in the same way that a long diversified equity exposure can be. And I'm not going to, we don't have time to go into too much detail on this, but I wanted to give you, an example of how that might work. So there's an index that's now, I think it's about 10 years old. It's the S&P 500 Dynamic Vector Index. S&P Dow Jones Indices built this in order to encode a sort of fairly common dynamic hedging strategy. It has positions in US equities as well as VIX futures from time to time, with the allocation essentially determined by the level of the VIX. Higher VIX, so I need more hedging, and the trend in the VIX. VIX heading up, VIX trending up or trending down will increase or decrease the VIX futures allocation. That's a slight oversimplification of what's going on here, but there is a publicly available methodology that you can read. What I wanted to do with this was just to illustrate that something that's even reasonably simple or simple enough to publish in an index and have a publicly available methodology gives an indication of the kind of performance one can hope to achieve with a dynamic equity hedging strategy using volatility. I've highlighted here the two periods, the 2008 financial crisis, the March 2020 COVID sell-off, to show how a strategy like that could have limited some of the drawdowns that you saw in the equity markets, while still not rising quite as much during the bull markets, but over the long term, potentially ending up in a similar place. Now, I am running out of time, so I will just very, very quickly say, we've been talking about the US VIX, 1 month VIX, based on the S&P 500. That's been around since 1990, but I'll do a very, very short advertisement for the fact that the same technology that underlies the VIX has been applied to options markets in various asset classes and geographies. VIX futures themselves on the original VIX are by far the most liquid, but in terms of indicators and in terms of giving you a gauge for volatility expectations, you've got a range of US equity indices, global equity indices, and cross asset class measures that can be also used not just to judge whether the VIX is high or low relative to other asset classes, but to think about cross asset volatility. Now, I've run slightly over time, so I will just move quickly to two things. I shared some conclusions and I advertised some further resources. First of all, VIX offers a transparent market-based estimate of future volatility. It has predictive power, and it reacts to market-moving events. And VIX futures are really the way to access exposure to volatility with an incredibly wide range of uses: hedging, premium harvesting, macro positioning, and implementing directional view among those. So, short advert. If you are interested in reading more, we did have to go quickly through a few things. I'd advertise both the SIBO and S&P Dow Jones Indices have both white papers like the Practitioner's Guide to Reading VIX and more tactical short-term things, including monthly dashboards and our indexology blog often features VIX. This presentation will be sent to you after the call, and you can have a click through and see those links. But for now, I will close up and pass on to Ethan. And thank you for your.
Hi, thank you, Tim. Okay, hi, good evening, everyone. My name is Ethan, and I'm from Phillip Futures. Firstly, thanks, Tim, for the elaborate sharing on VIX. And now that the attendees have an idea of the VIX Index, and if you would like to trade VIX Futures, you will need an account with a broker. So I'll be just here to do a very quick sharing on trading with Phillip Futures and also some of the broker support which we provide our clients with. So just a very quick introduction on Phillip Futures. We are a local brokerage that was founded since 1983 as a member of Phillip Capital Group. So actually this year is our 30th anniversary. And the group has clearing memberships in 21 global exchanges, including SIBO. And thus we provide you with connectivity to global markets. And when you're trading with Phillip Futures, you can also have an ease of mind as we are regulated by our financial authority here, MAS. And MAS has very strict regulations with, of course, a key intention to protect you consumers. Of course, in this modern landscape, I'm sure there are many other brokers which you can choose from to trade with, but just allow me to share some of the broker support which Phillip Futures is able to provide you with. Okay, so firstly, we have our proprietary in-house trading platform. It's called Phillip Nova, and this platform is for trading futures and options. It is browser-based and it provides you accessibility from your desktop, mobile, and also your tablet. So this is what it actually looks like for the desktop version for both the watch list and the order ticket. For order execution, there are three ways for you to place your orders. Firstly, from the order ticket itself, or you may trade via the market depth, or even directly from the chart itself. So placing an order on the trade ticket is also relatively easy and straightforward to do so, with various order types for you to choose from to execute your trading strategies. On top of that, we provide you with free charting with various built-in indicators and also multiple time frames to use if you are relying heavily on technical analysis to do your trading. And if you need any help with the indicators or platform, we also have a servicing team to guide you along, be it via face-to-face in our physical office, or if you want to do it online via Zoom, that's fine as well. If you are trading more heavily on your mobile, we also have a mobile app for our futures trading platform, and it comes with features such as news and also currency conversion to facilitate your trading. So everything else is pretty similar to the desktop version, the watch list, order ticket, market depth, and also the ability to trade directly on the chart itself. It's all available on the mobile as well. So some of the support that we provide our clients with includes regular seminars and webinars for both new and experienced traders. We also provide complimentary one-to-one coaching, where you can also meet us to learn more about the product, the platform, or to open a brokerage account here in our office. Okay, I think in this day and age, there are many of us that's mostly on our mobile phone all the time, and we check our messages more frequently than our emails. So hence we have this dedicated WhatsApp line to support your trading needs. And through this WhatsApp, we send out daily broadcasts on views from our analysts and also our upcoming events such as webinars. And of course, if you have any inquiries on your trading, on your account or trading related matters, you can also just drop us a WhatsApp text here. So this is the number that you need to take note of. +65 is the country code, and our number is 65335066. Do add this number to your contact list and talk to us on WhatsApp if you have any inquiries, and we will get back to you as well. For account opening, there are some prerequisites required here in Singapore for us to grant you futures trading access. So over here, you see 4 criteria: education background, working experience, trading experience, or this online e-learning. So all you need to do is just fulfill either one out of these 4. So the first one will be education background. If you have a relevant diploma or degree in business management, economics, and finance. So there's a list of approved courses for you to gain futures trading access. If not, then there will be working experience criteria, which is 3 continuous years of relevant working experience in the recent 10 years. If not, then there will be trading experience. So if you have been trading with another broker in exchange listed futures or options products in the last 3 years, and you have 6 or more transactions, we are able to grant you futures trading access as well. And of course, if you don't have the first 3 criteria, if you don't fulfill them, then there is this e-learning that you need to complete for us to provide you the trading access. Okay, so in any case, account opening with Phillip Futures is actually free, and there is no platform or account maintenance fee. You can always open a trading account first and trade once you have a view or if there's any opportunity. So there's this QR code here on the left that you can scan to sign up for a demo account to trade futures, or the QR code on the right to directly open a live account. Okay, with that, I hope you have some idea on our platform and also some of the service that we render. Should you want to reach out to us, feel free to, our contact details are below. Just feel free to contact us if you need to. And if you, of course, if you have any questions regarding brokerage, just let us know in the question box and we will address them accordingly. Thank you.
All right, thank you very much, Ethan and Tim. So moving on to our Q&A segment, our first question for the night is for Tim. You mentioned that you mentioned that the VIX is derived from a basket of options. Can you tell us more?
I certainly can, and let me start by saying I do apologise if people struggled to hear. As I mentioned, the slides will be available afterwards, and it's just a risk of the virtual environment that we operate in these days. Yeah, so if you would like to really get in the weeds, I would recommend the white paper. If you search a search engine for SIBO VIX white paper, that'll actually give you the full exact details of exactly which options get selected, how are they combined, and what actually gets you the VIX calculation. To give you a sort of a brief overview, what the calculation does is it uses a weighting scheme that uses options with lower strikes at higher weight. What that means in practice, so sort of think about this mentally, is it's weighted much more heavily towards deep out of the money put options than it is to deep out of the money call options. More focus on that downside risk. Now, why is that? Exactly, just to give you an idea. So the way that basket is constructed is the basket that one would build if you then hold that basket and delta hedge it, i.e. hedge the market exposure all the way through for the next 30 days, then the payoff on that portfolio from that strategy would be precisely the realized variance during the period of the S&P 500. So that's why it's called sort of implied volatility. You may have spotted, or smarter viewers may have spotted, he said variance there and volatility. So yeah, the final thing you do to calculate the VIX index is to take a square root. That square root in particular, from variance to volatility, is one reason why the VIX itself is properly uninvestable. You cannot replicate the VIX. You can, of course, buy VIX futures, which have a very, very close correlation to the VIX. You can, of course, buy options, which will get you a bit closer to variance. But it's the actual calculation involves the full strip of S&P 500 options all the way up, all different strikes based on the S&P 500, with a higher weighting on the lower strikes.
All right. The next question is, can you give your view on how good of an influence the VIX is on other markets like in Hong Kong, China, and Japan?
Yeah, sure. So I think there is a practical reality, which is that the S&P 500, although it is a US equity index, it is very representative of the health of the global economy. It's dominated at the top by companies like Apple, Microsoft, Amazon, which are genuinely global companies with international revenue sources. And it is clear historically and presently that US equity volatility is driven not just by events that affect the US domestic economy, but events around the world. Now, in some cases, one would want a purer direct domestic hedge, but what we've seen historically is actually overnight trading volumes in VIX futures and VIX related products is very strong during Asia hours. And what my experience has been from speaking to investors is, while the US VIX itself might not be the perfect, sort of exactly what you want for an Australian or for a Hong Kong or for a local domestic hedge, the liquidity of VIX futures and the global systematic nature of VIX means that many investors end up using VIX anyway, because for practical purposes, it's much more usable. And if you're talking about, the kind of events that shape the world, VIX will react because the US equity market will be affected.
All right, thank you, Tim. The next question is for you as well. Next question is from Howard, and he said, my experience with current month VIX futures, VIX futures, sorry, give me 2 seconds. Okay, the question says, my experience with current month VIX futures is that it does not correlate very closely with the VIX index. Why so, and how do I get closer exposure to the VIX index volatility?
Yeah, so what you'll generally see is that, and we actually had a slide on it, which was looking at the correlation of VIX futures to VIX spot. And there's a couple of things going on there. One is, the shorter the maturity of the future, the closer its performance will tie to the VIX itself. So SIBO has actually got 1 week futures now, if 1 month is still too far away, and the shorter the maturity of the future, the more it'll be driven, the higher it will be correlated to changes in the spot VIX. Futures further out the curve do have less sensitivity essentially to the current VIX because they're looking further out. The other thing just to be a little bit careful of is particularly around events. So if you take, say, a US election, if I'm looking at the VIX today, the election is the day after tomorrow, say, and the VIX future is actually talking about 30 days away or 2 weeks away, then things around that election are not going to be there in the VIX future because it will have happened. So there could be occasions like that when there's a natural disconnect between what's happening over the next 30 days and what future VIX is going to pertain to. But in broad terms, the secret, if you like, or the historical evidence would show that really, if you want to get a higher correlation to spot VIX, move further forward in terms of maturity. Those shorter maturities give you a better connection.
Okay, thanks, Tim. Since time is almost up, we'll pick our last question for tonight. The question is, what different strategies do people use to hedge equities with VIX?
And you'd like a short answer. I mean, the reality is that there are a lot. What I will say, one thing they nearly all have in common is they require a moderately high degree of maintenance. There is no real buy and forget strategy that I know of that is effective in terms of hedging equities with VIX. So they do require a degree of maintenance. They do require a degree of risk management, not least because, as we've seen, an investment in VIX futures can really spike up. We saw, I think, the couple of slides that I showed in March 2020, the VIX Futures Index went up by 400%. Well, if you had a 1% allocation and the equity market goes down and your 1% allocation goes up to 400% up from where it was and your equity's gone down, you can see that instantly at that point you've got a much larger allocation in your hedge than you would want just at the moment it's paid off. So that kind of is like a very obvious example of why these things tend to be very strategic, very tactical. They require a high degree of maintenance. Beyond that, some commonalities, generally speaking, you often see some level of trend involved. You definitely see people trying to identify regimes. And one thing that's very, very common is to try and work out whether the level of insurance is essentially rich or cheap right now. I'm so sorry, we can only scratch the surface really there, but please do join the next two series and webinar when hedging strategies and further examples, I believe, will be given by other speakers.
All right, thank you very much for the insights tonight, Tim and Ethan. And thank you very much, everybody, for your time tuning into this webinar tonight. We will be sending everyone a link to today's webinar recording as well as Tim's slides, so you can watch and review the content again if you would like to. And as mentioned, this was part 1 to 3 in the VIX Index webinar series. We will be including the links to sign up for parts 2 and 3 as well. That's all for today. Thank you, everyone, and goodbye.
Thank you.